Intercompany transactions are business transactions that occur between companies within the same corporate group. For example, one subsidiary may sell inventory to another subsidiary, provide services, issue a loan, or charge management fees. Intercompany accounting follows three major steps: recording the journal entries, reconciling the balances between companies, and eliminating those transactions during consolidation. In this video, we'll walk through the entire process in less than 5 minutes. An intercompany transaction occurs whenever one company within the group provides goods, services, or financing to another company in that same group. In this example, subsidiary A sells inventory to subsidiary B for $10,000. Subsidiary A records the sale and sends an invoice. Subsidiary B records the purchase and eventually pays the invoice. Although this looks very similar to a normal customer transaction, there is one important difference. Both companies belong to the same parent company. Because these are internal transactions, they should not ultimately appear in the consolidated financial statements. Even though the transaction is internal to the group, each legal entity must still record its own journal entries in its own accounting records. The selling company records an intercompany receivable and sales revenue. The buying company records inventory and an intercompany payable. Notice that the receivable on one company's books should equal the payable on the other company's books. And if those balances do not agree, the reconciliation process becomes much more difficult at month end. Intercompany balances must agree before the financial statements can be consolidated. In our example, subsidiary A shows a receivable balance of $10,000, while subsidiary B only shows a payable balance of $9,850. That creates a $150 difference that needs to be investigated. Common causes include timing differences, foreign currency fluctuations, incorrect account coding, duplicate entries, or selecting the wrong intercompany partner. The earlier these differences are identified, the easier the month-end close becomes. Most companies follow a structured reconciliation process each month. First, both entities extract their intercompany balances from the general ledger. Second, the balances are compared between the related companies. Third, any differences are investigated and researched. Fourth, correcting entries are posted if necessary. And finally, once all balances agree, the accounts are ready for consolidation. Now, depending on the company, this process may include receivables and payables, sales and purchases, loans, inventory transfers, equity transactions, and foreign currency differences. After reconciliation comes the elimination process. Remember, consolidated financial statements should only report transactions with external parties. If we leave both the internal sale and the internal purchase in the consolidated financial statements, revenue and expenses would be overstated. And to prevent this, we create elimination entries that remove the internal activity. In this example, we eliminate the intercompany sales revenue and the related cost of sales. And after the elimination entry is posted, only external transactions remain in the consolidated financial statements. Let's summarize the complete intercompany life cycle. First, an intercompany transaction occurs. Second, both companies record their journal entries. Third, the balances are reconciled. Fourth, any necessary corrections are posted. Fifth, elimination entries remove the internal activity. And finally, the consolidated financial statements are prepared using only the transactions with outside parties. The key takeaway is simple: record it accurately, reconcile it consistently, and eliminate it completely. And that's how companies ensure accurate consolidated financial reporting.